Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Patrick Wolf, Head of Product Development at Nasdaq Global Indexes. Patrick led Nasdaq's efforts to build and launch the Nasdaq Veles California Water Index in partnership with WestWater and WestWater Research. We also have Matt Payne, Principal at WestWater Research, which provides the transactional data and subject matter expertise that underlie the NQH2O or the Nasdaq Water Index. Gentlemen, it's great to see you both again. Welcome back to Trade Talks. And Patrick, I'm going to kick it off with you. The Nasdaq Water Index aims to represent the spot price of water in California. Is there a single price for water in California?
Well, no, actually, there's not. And that kind of is the logic behind why we developed an index in the first place. So to say that there is a California Water Index is probably a bit of an oversimplification of a lot of the nuance that occurs within the physically traded water market in California. But when we think about the water market in California relative to a more robust and perhaps fully matured commodity market, the distinguishing factor that we think about is this lack of two things: a central clearing point and symmetrical information across buyers and sellers. And so starting with that first piece, when you think about something like oil with Cushing, Oklahoma, or natural gas in Henry Hub in Louisiana, there are these confluences in the physical conveyance of the particular commodity itself that people reference when they think about buying the physical spot or the physical forward commodity itself. And so within California, there isn't really that centralized point through which water is conveyed and a location that buyers and sellers can come to think about physically settled transactions. And so what we end up with is this disparate organization of kind of sub-markets across the state. And so what we have done with the NQH2O index is to take all of that transactional information, which in and of itself is a robust and lively market of buyers and sellers, and try to synthesize that into a single reference point so that buyers and sellers who are really focused on a particular piece of the California water market have an aggregate data point to really think about where are the broad directional trends within our marketplace, and what information can any one buyer or seller divine from the movements in the index as it pertains to their local market and the asset in which they would be transacting. And so as a result of this aggregate activity, what NQH2O really represents is a combination of surface water market transactional activity and groundwater market transactional activity. And so the surface water market is water that's conveyed above the surface of the earth via various infrastructure to move water predominantly north to south. And that really takes the shape of state water project allocation water and Central Valley project allocation water. And then within the groundwater market, we look at four of the most actively adjudicated groundwater basins, those being the Chino Basin, Main San Gabriel Basin, the Mojave Basin, confined to the Alto sub-area, and the Central Basin. So that activity is sent to us by WestWater Research on a weekly basis. And then every Wednesday morning, NASDAQ runs its algorithm to normalize those prices and produce a real-time index value that is indicative of the previous week's transactional activity. And so to say that there's a single price, no, but what we have is that single referential benchmark that is that key piece of information that the market hitherto was missing, and we hope will catalyze a lot of virtuous activity within the physical market itself.
Matt, if local spot prices differ from NQH2O, how can physical market participants make use of the index when assessing fair value for water in their local market?
So, Jill, the concept you're referring to in that question is called basis. Basis is the relationship between a hedger's price and their local water market. So the price that water user is experiencing in their local region compared to the water futures contract price. So just to give a hypothetical example, say the June 2021 water futures are currently trading at $650 per acre foot, but a local water market is currently priced at $750 an acre foot. The difference between those two prices is $100 per acre foot, and so that is the basis. Now there's also this issue of basis risk, which is that difference between the futures contract price and the local water market price changing over time. So that difference between the two prices can narrow or it can widen. And then what we see in the water market and in other markets where pricing information is opaque, we see an issue of perceived basis, where hedgers sometimes believe that their basis is larger than it actually is because they may have incomplete market information. They may be relying on a single anecdote of a price that was, above where the futures are, but maybe that was a small transaction of 100 acre feet and they don't know where the other 400,000 acre feet in the market is trading, or they're relying on quoted offer prices from sellers where maybe the transactions haven't actually been completed at that price, but they're referencing quotes that are out there in the market. So there can be this issue of perceived basis, which is different from actual basis.
Patrick, how does basis impact the NQH2O index, and how do you look to address that?
So certainly when we look at the transactional data that WestWater is sending us, what we are seeing are fully consummated transactions, as Matt was alluding to. So these are deals that have gone through the full gamut of the regulatory process that governs every physical trade that enters our data. And what we end up seeing is even within a single asset and a single location at a single time, we can see materially different prices paid by buyers and sellers. That's the kind of market inefficiency from a classical economic perspective that we don't necessarily look to ameliorate or kind of wish away. We do have methods of accounting for those types of kind of inefficiencies in the price discovery process. But really, what we try to focus on within our methodology is an entirely rules-based algorithm that we pass over that WestWater data to come up with that new weekly value. We try to address some of the systematic differences that we know to be persistent and material differences that are really reflective of different circumstances facing buyers and sellers of a particular asset or that are located in a particular part of the state. And so just as a couple kind of quick examples of what we're talking about, when we look at the surface water market and particularly the state water project system where the San Joaquin Sacramento River Delta plays a very important role in the conveyance of physical water. What we tend to think about with those trades is the location of buyer and seller with respect to the delta. And so one particular type of transaction that is of concern to us is when we see a seller of water that is located north of the delta and a buyer that's located south of the delta. In those instances, those trades are subject to some sort of conveyance loss subjected by the regulatory body that oversees the state water project, the Department of Water Resources. So the DWR will assign a haircut, if you will, to that trade once they fully approve that trade and it becomes fully consummated. And so what we do is we adjust the volume of that transaction downward by that conveyance loss factor and apply the reciprocal to the price. Because in essence, buyers and sellers are buying a certain amount of acre feet of water at a stated price, but both buyer and seller know that that volume that will actually be delivered will be something less than 100% of that trade. And so that's an example of where we try to account for a systematic difference in certain transactions to avoid introducing any type of noise into the weekly value of the index that isn't reflective of buyers and sellers trying to come to an understanding of where marginal changes are driving price in terms of those changes in supply and demand. And the final piece I would add is just that but across assets with groundwater and surface water, we try to observe certain persistent differences in price points such that if one market or one asset trades at a premium or a discount to the other, we apply a adjustment factor on using backward-looking information, and we update that in order to keep it up to date with where market prices are moving the price of a particular asset relative to another. But all of that is really an effort to ensure that we're not seeing any jumps in the index that are attributable to differences in the asset under consideration itself.
And Matt, to wrap up here, CME recently launched cash-settled futures benchmark to the NQH2O index. How might California water market participants consider basis when using water futures to hedge local price risk?
Sure. I'll give you an example. So basis is present in essentially every commodities market, and those markets still widely use futures to hedge price risk. So even in a situation where you have basis and even basis risk, futures can be valuable tools for hedging price. So by way of example, assume there's a local water market participant, say for purposes of example, it's an almond grower. And this year is shaping up to be extremely dry. So that almond grower anticipates being in the market, purchasing water during the summer, during the irrigation season. And currently they're seeing prices in their local water market at $750 per acre foot. Now they go look at where the June water futures are trading, and those are priced at, say, $650 an acre foot. So there is a basis there of $100 per acre foot. Now that almond grower says to themselves, well, $750 an acre foot for water is very expensive. It's going to be a tough year no matter what, but I can't have the risk that that price moves even higher on me. So they choose to buy those June water futures at $650 an acre foot. They take a long position to hedge that exposure. Now fast forward to, call it June 15th, that almond grower goes into the water market and has to purchase water at $800 per acre foot. Their fear has been realized. Those prices have moved up from $750 an acre foot to $800 an acre foot. Now, at that same time, the June water futures have advanced to $750 an acre foot. So they've moved up $100 per acre foot. And now when you compare that $750 an acre foot futures price to the local water market price of $800 per acre foot, the basis is now 50. So the basis has actually narrowed. Now, the result of that trade, the almond grower will have paid an extra $50 per acre foot for their water. So they paid $800 an acre foot. But from their futures trade, they realized a gain of $100 per acre foot, which offsets that physical water price. So when you consider the $800 per acre foot paid for the water, minus the gain on the futures trade of $100 per acre foot, the almond grower now has a net price of $700 per acre foot. So not only have they effectively hedged the increase in actual water prices, but they've realized a price that's lower than what they were seeing in the market in March. And that's just one example of how the water futures are valuable, even with a situation where there's basis and basis risk.
All right, Matt, Patrick, appreciate the insight. Thanks so much for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.